Hello and welcome to KYC, a show designed to give regular investors powerful, actionable insights into fundamentals of a single NSE-listed company every day. Today, we are talking about Indegene Limited. Now, while this is a company from the healthcare space, it's a unique one. What this company does is it, in fact, aids other pharmaceutical companies in carrying out, trials and tests, and eventually helps them market these products. But let me tell you a little bit more about Indegene and why we're talking about it. Of course, we've had the earnings from the company, but in general, it's a digital-first healthcare and technology company. That's what we're looking at. Besides that, it assists life sciences companies with drug development and clinical trials, as well as regulatory submissions, and eventually taking some of these drugs into the market for their respective clients. In terms of the revenue breakup for FY24, to give you a better idea of where it gets a majority of its revenues from, well, the company essentially gets enterprises commercial solutions is what contributes to nearly 59%, followed by enterprise medical solutions. That contributes another 23%, as you can see. The balance will come from omni-channels and others, but the long stay as far as these two segments are concerned. Even in terms of your clientele will split, well, it gets mostly majority of its revenues from biopharma, followed by medical devices, emerging biotech, as well as others. Now, as usual, what we tend to usually do is, well, we talk about the various parameters that we judge the company on. So we talk about the income statement, the balance sheet. We talk about the return ratios based on those two financial statements. And of course, we also talk about the cash flow. And we move beyond the financial statements when we take a look at the shareholding. We take a look at street credentials, street coverage, as well as the outlook for the company as well. And we rate the company. We give you a total rating of the company. To help me do this and take us through some of these aspects, well, I have with me my colleague Varsha, who's also going to take us through some of them. So let me bring in Varsha and let's talk about, the top line, the profitability in terms of margins, and the bottom line. Varsha, welcome to the show and thanks for joining in. What can you tell us about this particular aspect?
Thank you, Agam. So, if I were to see the last 3 AGR growth for Indegene and FY24 numbers, in FY24 the revenue was 2,590 crore, while EBITDA margin was 20%, net profit was 337, and if you see the 3-year CAGR growth, its revenue has grown 39%, EBITDA 30%, and net profit 32%. Well, this seems good when it comes to last 3 years, but the problem here lies if you see Q1 FY25, Q2 FY25 and the recent numbers Q3 FY25, the numbers are not that good. If you see, the revenue growth has been like 7 to 8%. So overall this looks good from FY24 basis, but when it comes to the recent numbers, the numbers are not that good, and the margins have also gone down. So the margins have gone down to 17 to 18%, wherein in March 24 the margin were 22%. So yes, overall we would give a thumbs up, but we need to keep a watch on what lies ahead in Q4 as well as in FY26.
Right, so that's as far as the balance sheet is concerned, and pardon me, that's as far as the income statement is concerned. So I'm going to talk about the balance sheet as well. As of now, it does look like it does have a strong balance sheet. It has no debt, negligible debt, which is as good as zero debt, but as against shareholders' equity worth around 2,400 crores, nearly 2,400 crores, and this is as on September 2024. Again, it has a significantly higher cash in bank worth around 550 crores, and this is higher in comparison to its gross debt, that is its lease liability essentially. So it's, well, on a net basis, it's debt-free, and it does have a significant amount of reserves. We must also remember that the company is coming out of a very strong growth phase. Obviously, a lot of that has come and contributed towards the balance sheet as well of late, which is why we're looking at such a strong balance sheet. So it's going to be a thumbs up as far as the balance sheet is concerned as well. Varsha, what about the return ratios? These also look pretty good.
Actually, yes. they are good when it comes to, FY24 numbers. So you have return on equity of 28%, 27% in 24 and 28% in 23. And ROC numbers are actually very good when it comes to 23 at 33% and 24 at 29%. But this, because considering the, net profit decrease or considering the subdued numbers that the company has seen in the last few quarters, we need to see what FY25, return ratios look like. But overall, considering this 2 years, yes, good, very good return of ratios. Now also, we need to consider that company doesn't have to do much capex, because they're not into kind of manufacturing drugs or manufacturing any kind of products. They give services to the pharma companies which bring products, which they help pharma companies products to bring into the market. So not lot of capex is actually required, and this is also reason we are seeing the good return ratios for the company.
No, fair enough. I think it comes down to what these return ratios will eventually look like. But as far as the past is concerned, well, it does look good. I'm going to also talk about the cash flows. And again, when it comes to cash flows from operations, it's a pretty steady state at the moment. Well, what we're looking at is about, 508 odd crores coming in from cash flows from operations, and on a net cash flow basis also, it's a positive number. So overall, that's how things are, as far as cash flows are concerned. Just want to point one thing out, that while we have seen steady growth, the management at this point in time is indicating a slightly closer to double-digit growth. And while we may or may not see double-digit growth for the upcoming, few years, the management is suggesting that they will beat the sector. That's as far as financial statements are concerned. Let's, look beyond and talk about the shareholding too. The reason why I want to address shareholding is because it's a bit peculiar. So firstly, it does not have promoters. It does have institutional holding, but institutional holding is relatively low. Sure, you might argue that you've actually seen an increase in FII holding and an increase in DII holding over the course of the last 9 months, the last 6 months. But overall institutional holding for a company that does not have a promoter is, fairly low, as I mentioned. It does, however, have two marquee investors. The first one, of course, is a Singapore-based venture capital company. That's Nat Arthur Far East, which owns about 22% in the company. And the other relatively large investor is CA Dawn Investments. This is a Carlyle unit. So that they own about 10% in the company. While we do have significant ownership by these two marquee investors, the question really is that what about the balance? This just adds up to about, 32%. So the balance is out there, and as I mentioned, the institutional holding in the company is not significant just yet. If you move that on the side, we do consider the shareholding as a little bit of a weak spot as far as the company is concerned. But Varsha, what can you tell us about how the company's price has done since its IPO?
Well, yes, Agam. So if you see since listing, so this company got listed in around May 24. Since listing, they've gained 30% on IPO issue price. Now, this looks good, but from listing day close, the stock is up only 5%. Now, Indegene being a small cap company, the investors, the expectations of investor from this company would be at least a double-digit growth in stock price that they must be interesting. And now, but the stock price is up only 5%. Now, company needs to prove when it comes to their financial numbers, so that the valuation premium the market can give to this company.
Yeah.
And also, if you see, if I were to talk about the street view, so they have 3 buys, 2 holds, and 1 sell, but the upside potential for this company lies at 14%. And actually, in recently, a lot of analysts are interested into this company, maybe considering the future prospects that the company has. But overall, from a street cred or from a returns point of view, we would give a neutral stand to that.
Okay, so Varsha, I'm going to come back to you on the outlook for the company, but I do want to make a point with respect to the upcoming growth. And I've made a point on this, but I'm going to emphasize a little bit more on this one. So firstly, when it comes to growth going forward, and outlook again will be something of importance, because the management is saying that while they have grown, 39, 35% over the past few years, we're not going to see the growth anywhere close to those numbers here on. It will be, well, maybe somewhere close to the double-digit growth, but it may not be. They are saying that they will grow faster than their peers and faster than the sector. But in general, it will not be. Of course, the management, or rather the company, is also growing at or has grown over a smaller base so far, and now the base has become slightly larger, and here on, it does seem like growth may not be, well, as exponential as what we've seen so far. So that's one of those areas that may be of a little bit of a concern. But what about the other factors in terms of the outlook here, Rasha?
Yes, Agam. So one thing is that company is actively, scouting for M&A acquisitions. So basically here the simple point is the company is going to expand through inorganic acquisition, number one. Number two is now they want to increase their client base, and especially increasing the $1 million client. Now this is very important. One is what additions of clients you have taken and what is the size of that client. This is the second important thing which they are actually concentrating on, and they want to have EBITDA margin to stabilize at 20% in near term. Now, in Q2 and Q3, the margins were 17 to 18%. They want to take overall margins to 20 to 22%, with medium term exceeding 24%. Now, we need to see what strategies have laid down management to have this 22 to 24% of EBITDA margin that they are expecting. So overall, yeah, I mean, a good kind of outlook, but management needs to prove themselves that what they are saying, they need to, walk the talk kind of, management we need to have.
All right, fair enough. So that's as far as how the outlook is concerned. We're going to give it a neutral outlook at the moment because of some uncertainties and also a slowdown in growth. Where does that bring us when it comes to your overall rating after considering all the parameters that we've spoken about right now? So certainly, so far in terms of the financial statements, the company looks at a very strong footing. So we've given thumbs up on all the major statements. But let's move on and talk about the other factors. So it's a thumbs down for shareholding, neutral otherwise on street credentials. That is the kind of returns that the company has seen, street coverage as to what the street is making of it. And the outlook, of course, also remains neutral. And given the fact that we give a thumbs up, 1 point, about half a point for a neutral and no points for, a thumbs down, the total score at the moment comes to about 5.5 out of 8. The outlook at this point in time is something that's going to be at the forefront of every shareholder's mind at the moment. But speaking of that, let's get in the management. Well, I spoke to the CFO of the company, Suhas Prabhu. This is what he had to say. Listen in.
Yeah, as you rightly observed, a good quarter from a sequential growth perspective, strong 4.9% revenue growth with strong margin growth. We crossed the 700 mark in revenue for the first time, and also 150 crores in EBITDA and 100 crores plus in PAT at a healthy 15.2%. We strive to maintain this level of performance with also stable to growing margins going forward. And given our pipeline and new wins, we feel confident that we are on the right path going forward as well.
Okay. But can you give us some sort of a view? Because, over the past few years, you guys have shown revenue growth of around 30-35%. And at the moment, we're looking at, well, somewhere near double digits. But the question really is that what can we expect in the top line for FY26?
Sure. Well, I'll refrain from giving a forward guidance specifically, but if you look at a slightly longer and medium-term perspective, dialing back, while as you rightly pointed out, a couple of years of 30% plus growth was there. What we believe is that over a longer period, we should deliver growth which is higher than what the industry is growing at, which is at 5 to 6%, and outsourcing in this industry growing at a 9 9 to 12%. And we will strive to actually beat that and go beyond. And that's our ambition. Now, there'll be periods where it'll be slightly slower, and there'll be periods where it is very high, like the 25, 30%. But over a medium term, we'll strive to beat what the industry and the outsourcing trends are.
Okay, so not at the same clip as what we are used to, but still beating the industry. That's what we gather. Suhas, also a word on margins at the moment. What are the challenges? Because the indications and the expectations are about 20 to 22%. But we've actually seen margins come off just a tad bit sequentially. So where do we head from here? What are the current challenges, and what is the company doing to overcome some of these?
Actually, margins at a EBITDA level have come in strong sequentially. We've grown EBITDA margins by 240 basis points to 20.8% sequentially, which is in the range, north of 20% that we have delivered in the past. Even on a YTD basis, we are in the vicinity. We are just short of 20% at 19.7, 19.8%. And given that the inflation and, more importantly, the wage bill hike is behind us, we believe that the performance will be stronger going forward on the margins also, such that on a full year basis, we should be in the range that are the expectations based on our past performance.
Okay. So Suhas, let's talk about business and particularly enterprise commercial solutions, which forms a very large chunk of your revenues. What's in store as we move into FY26? What are the areas that this particular segment will focus in?
Yes. So enterprise commercial solutions, the largest part of our business, is where we transform our customers' commercial operations and help them effectively engage with the market. And this is an area where we see significant changes, one coming from the regulatory side, pricing pressures and a changing product profile with the new innovator products hitting the market, needing the industry to transform the way they engage with the market, while new technology and personalization requirements also bringing up new requirements. And confluence of all of this, we believe we are very well poised. Having said that, we are also having a strong pipeline. We've seen progress many of our customers, where we continue to do more and more and add more value in this process, and we have remained very bullish on this segment.
Okay. Can you also give us an idea about the same when it comes to your enterprise medical solutions?
Enterprise medical solutions has seen a strong growth. One with increasing regulatory complexity, right? There's a natural requirement to enhance, what our customers are doing, which impacts us positively in this segment. And the other thing that we have capitalized in the recent future on is we saw increased outsourcing trend in some of our customers, especially outside the top 20 globally ranked pharma, doing more outsourcing in this segment, coming out of newer requirements, higher requirements coming from the regulator. And that has resulted in this growth. And we see that continuing in the future as well.
Okay, so Suhas, if we look at your business maybe 2 or 3 years down the line, I'm assuming that a very large chunk of your revenues will still come from commercial solutions and medical solutions. The question is that, is the mix likely to change, or will that depend from year to year based on what the demand from your own clients will be?
Yes, you rightly mentioned that again, we're not seeing a major shift in the proportions. There might be interim changes where there'll be a small variation, 2 to 3% between the segments. But in the longer term, we don't see the proportions changing drastically between these segments, even as we scale from the current levels of revenue.
Okay. Suhas, can you tell me about the kind of clients that you've seen in terms of addition for the quarter gone by, and what is the size of these clients?
Sure. One of the things that we are proud of is the fact that we work with pretty much all the top 20 global pharma for a very long time. And therefore, naturally, that means that my client addition, my logo addition, is in the going beyond the top 20 pharma. Now, when I say going beyond the top 20 pharma, these are still very large enterprises ranging anywhere between $2 billion in revenue to maybe $5-10 billion in revenue, my customer revenue sizes. And they also have all the requirements, of course, at a slightly different scale than the top 20 pharma, but the requirements remain constant. We see that there is significant revenue potential with these customers also. So while we strive to get our top 20 globally ranked pharma to a $50 million, $75 million, $100 million customer for us, the next tier customers could very well be a 25, 35, $50 million customer for us. And that's the potential we are excited to tap into.
Okay, so Suhas Prabhu telling us about what's in store. So firstly, we've spoken about growth, where they said that while the sector can likely see growth of around 6-7%, Indegene is most likely expected to beat that particular growth. But it's going to be closer to double digit and not anywhere close to what we have seen in the past few years. In terms of margins, they are, well, looking forward, eventually they will hit the 20% margins. Right now, we've seen those margins come in at around 18-19%. And, moving in as far as their strategy with respect to the current clientele is concerned, firstly, they are going to look to grow with the growth in their respective clients. They're going to look to consolidate. The concentration risk at the moment is not considerable. Sure, they do get about 83% of their, or rather well over 80%, or rather well over the 4/5 of their revenues from their top 20 clients. That's a good one, but they're looking to consolidate there. And of course, in the meantime, as and when they get to see for newer additions in clients, that will also be a part of the process. That's what we have in terms of KYC in today's edition. And that is all that we have, but lots more lined up on the other side. Stay tuned to NDTV Profit, and we'll keep bringing you more.